Thank you for joining us today for our presentation on captive insurance. Today we'll review the history of and provide an overview of the alternative risk transfer strategies. We will discuss how captive insurance may be a way to reduce insurance costs and develop alternative revenue streams. Mike will review the various types of captive insurance arrangements commonly used today and the steps involved in implementing these structures. I'm Carolyn Powell. I'm Development Director here at Tronconi Seguir & Associates, and I'll be your host today. There's a couple ways that you can engage with us. So there should be a toolbar on the right-hand side of your screen. Over there is a copy of our handouts of today's presentation, a bio of Mike and his background, and then there's also an appendix in there that he'll be referring to in the presentation. There's also a questions box that if you have any questions throughout the presentation, feel free to go in there, type your question to Mike, and we'll get that answered for you. After today's presentation, you will receive a survey. If you could just fill that out for us, that would be great. Give us some feedback. Let us know if there's some other topics you're looking for. And then also too, if you'd like to schedule a one-on-one meeting with Mike and or have additional questions, you can put that in the post-webinar survey. I will also send a copy of today's presentation and a copy of the slides and appendix this afternoon. So if you'd like to go back, I will be sending that, or if you want to send it to a colleague that wasn't able to make it this morning. So without further ado, let's get started. Tronconi Seguir & Associates is a certified public accounting and business consulting firm. Today's expert is Mike Baritot. He has a master's and over 30 years in the accounting industry. He works in a broad range of industries and works closely with individuals, business owners, and business owners and families to grow, preserve, and distribute their wealth while minimizing the impact of taxes. So I'm going to hand it over to Mike and have us get started today.
Thank you, Carolyn, and welcome everyone. It's a pleasure to be with you here this morning. As Carolyn mentioned, I am Mike Baritot, tax counsel with Tronconi Seguir & Associates. The issue of captive insurance has come up several times since I joined the firm just a little bit over a year ago. And since it happened to be an area that I'm pretty familiar with, we thought it might be a pretty good topic to cover in a training session since it seemed to be coming up on a fairly regular basis. So here goes. Let's start with the premise that insurance companies are in business, just like any other business, to make a profit. They make a profit by collecting from their customers more in premium dollars than they are required to pay out in losses and claims. They can determine the pricing for the products and the policies that they deliver. If they charge too much, customers will go elsewhere. If they charge too little, they'll lose money. But unlike most any other business, they really have no idea what their ultimate cost of goods sold is going to be. All they can do is rely on actuaries to estimate what their costs and their loss ratios are. The rest is up to chance, and in many cases, as we've often seen, it's up to Mother Nature. So with profitability on the line and the uncertainty of loss payouts, it should come as no surprise that insurance companies tend to play it safe and tend to err on the side of charging too much premium rather than too little premium. The greater the uncertainty as to the frequency and the volume of loss payouts, the higher the premiums tend to be. And so it's this dynamic that created really the alternative risk transfer industry, also known as captive insurance. I've personally been involved in captives from a tax perspective for over 35 years. To be effective, the strategies are heavily reliant upon achieving the desired tax results. So in serving my clients over the years that participated in these structures, I've been involved in all aspects of forming and managing captives and defending them against IRS challenges. Now, before we turn to the agenda, just a quick question for all of you. How many of you in managing your own auto, homeowners, or health insurance costs have opted for a high deductible insurance plan? Well, in doing so, you've actually participated in a form of alternative risk transfer. You've essentially retained a portion of your insurance premium dollars, and in exchange have assumed that first $500 to $1,000 or more of risk. What you're doing is you're basically betting that you're a better risk than the insurance company thinks you are, and that you can profitably manage that layer of risk to your financial benefit. From a business perspective, this is what captive insurance is all about. However, as we'll see, there can also be important tax advantages as well. Now, if you'll turn to the agenda, this is what I hope we're going to be able to cover with you this morning. We're going to start with a discussion of the beginnings of the whole concept of captive insurance and some of the unique business risks that gave rise to the proliferation of captives. We'll then spend some time talking about the history of IRS and their response to captives, the various ways they attempted to defeat the concept. We'll also talk about some of the characteristics that might lead a business to consider a captive and the benefits from a tax and a financial perspective. We'll cover some of the unique tax benefits afforded to a concept referred to as micro captives, sometimes referred to as an 831B captive. And then we'll talk about some of the steps involved in setting a captive up. And finally, review a couple of recent situations that we've come across within our own client base, without using client names, of course, but it will help put some of this into perspective and help you better understand where and how these may fit into your own businesses. The concept of captive insurance from a historical beginnings is attributed actually to a creative insurance agent in the state of Ohio by the name of Fred Rice. Fred Rice had a client by the name of Youngstown Sheet and Tube. Youngstown Sheet and Tube was basically up there with Bethlehem Steel as one of the largest steel producing companies in the country. And in addition to its production and production operations and melting operations, it also operated its own coke and iron mines. And it was facing unbelievably high insurance costs associated with the operation of those mines. And Fred Rice decided or concluded on his own that the company would be better off forming its own insurance company, paying its insurance company premiums and insuring its own losses through that company. This concept became very popular in many industries as a way to reduce insurance costs and to cover risks that traditional carriers were shying away from or just charging too much premium. There is an appendix, I'll refer to it now. We're not going to cover the entire history, but if you want to gain a better understanding of the entire history of insurance, you can refer to the appendix at the end. So this is what a typical captive structure looks like in its simplest form. You have a parent operating company. The parent forms a fully licensed and regulated insurance company that is 100% owned by the parent. It then pays premium dollars into the captive insurance company. And the insurance company in turn provides insurance coverage. The key benefit from a tax perspective in this is that as a licensed, regulated property casualty insurance company, that company is able to deduct reserves for the losses that may occur in the future. Now, if the parent company were to try to create this type of arrangement within its operations, it would not be entitled to a tax deduction for reserves that it set aside to cover future losses. But an insurance company, under the Internal Revenue Code, is one of those few legal entities that is allowed to establish and deduct currently losses that may occur in the future. And so what you have is the captive insurance company essentially shelters the income that it takes in premiums with the loss reserves that it establishes, and the parent gets a deduction. Needless to say, the IRS really didn't like this arrangement very much. Their view of this situation was that you're just moving money from your left pocket to your right pocket, and you're getting a tax deduction that you otherwise would never be entitled to take. The IRS used three arguments on a fairly consistent basis to attack these arrangements. The economic family doctrine, that basically there was a lack of risk shifting outside the consolidated or related party group. Nexus of contracts was another concept. A little bit of a more esoteric argument, but much the same as the above. Also, they would argue that it was simply an assignment of income, not a valid insurance arrangement, and therefore should not be treated as premium dollars going out and going in. They did have success. The IRS did have some success over the years in lower court rulings, but for the most part, and as we'll see, over time, many of these lower court cases were overturned on appeal. Where the IRS has been successful is in situations where taxpayers got too aggressive and tried to insure risks that were just either unreasonable, not likely to ever occur, or where there was sloppiness, I'll say, in the formation, operation, and management of the captive. Mostly, I'd refer to it as just bad planning and bad execution. The tide began to turn in the early 90s with a series of cases, Harper being one of them, Sears and Allstate being another, where the lower court cases started to become overturned by higher level courts, and they started to look very hard at the, I'll say, the form of what these companies were doing as opposed to the substance, and really looked into whether there was a legitimate insurance business going on. They looked at whether there was real insurance risk. They looked at whether there was both risk shifting and risk distribution. They looked at whether there was insurance in its commonly accepted sense, in the sense that insurance is not a well-defined concept in the Internal Revenue Code, so they had to look at general definitions and standards to determine whether these arrangements involved legitimate insurance. Down to what the court even referred to as the subjective duck test. Does it walk like a duck, talk like a duck? Does it really look and act like an insurance company? After these cases in the early 90s, about another 10 years went by, and again, there was more and more of these cases where the IRS was losing based on these standards. And in the wake of all this, the service began to take a second look at it, and finally around 2001 started to wave the white flag, as it were, and said, okay, this is not an area we're going to be successful in litigating. We need to create some rules that everyone can follow and live by, create some certainty of outcomes for taxpayers, and actually codifying what we think are the acceptable standards coming out of the courts. So we got, in 2001 and then 2002, a series of revenue rulings that began to lay the groundwork for what became the foundation, really, of the captive insurance industry. Rev ruling 2001-31 was one of the first ones, and the service abandoned their economic family theory in trying to defeat captive insurance arrangements. 2002-89 established a standard of 50% unrelated risk. So if your captive insurance had 50% related party risk, 50% unrelated party risk, it was deemed to be acceptable from the IRS's perspective. They also established a 12 subsidiary test. So if a parent company had 12 or more operating subsidiary corporations and used those as the premium payers in its captive insurance arrangement, that established sufficient amount of risk shifting to make the insurance company a legitimate insurance company from the IRS's perspective. And finally, 2002-91 provided their approval of homogeneous unrelated group captive arrangements, which were really starting to become very popular in a number of different industries. So we talked about the 50% threshold. That's essentially saying that 50% of the premiums have to come from a non-parent, non-related entity in order to be acceptable. The Harper case actually set this at 30%. So in planning, we think the real answer today is somewhere between 30 and 50%, but most of the arrangements that I've seen and most of what practitioners try to accomplish when they're establishing these arrangements, you try to get to 50% or more unrelated party risk so that you don't run afoul of the rules that are accepted. How do companies accomplish this? This would be way beyond the scope of this presentation, but your captive managers are familiar with planning around this standard and using reinsurance and pooling arrangements to establish that 50% threshold. So it's not something that's difficult to accomplish, nor does it create an undue amount of risk. It's something that is known, understood, acceptable, and can be accomplished with proper planning. And as I said, the other way to accomplish this is if you have an extensive consolidated group with more than 12 brother sister companies, you can accomplish risk shifting through that. So let's talk about who should form a captive. Generally, it's going to be a situation where the company has an above average risk profile or unique risks that the traditional insurance carriers do not want to cover or just do not want to cover at a reasonable rate. Company needs, or the individual owners of the company, need to have the financial resources to contribute to a captive. Captives need to be capitalized with a sufficient amount of funds to support the risks that they're carrying. That will vary by, obviously, the policies and so forth, but it does require some financial investment. Generally, when we're talking to companies about a captive, we look for companies that have at least $3 million in gross revenues and at least $300,000 in annual insurance premiums. Some of the companies that are well suited for a captive arrangement. And essentially what you're looking for is companies that either have some unique risk characteristics associated with them or a unique legal entity structure that lends itself to the risk distribution requirements. So one of the first groups, I will say, that got heavily into captive insurance arrangements were doctors and other professionals that had significant malpractice exposures. And these are, the type of risks that don't happen often, but when they do, there's generally a high level of dollars associated with those risks. So low frequency risks, but high dollars associated, high volume associated with those risks. Those present excellent opportunities for forming a captive. And as I said, doctors and professionals in those professions were one of the first to really embrace this concept. For manufacturers, things like product liability can present, again, a significant dollar risk, but hopefully something that doesn't happen very often. Another area where we see captives is in the auto dealer industry. Auto dealers often write extended warranty policies on the used cars, not new cars, obviously have a manufacturer's warranty, but on the used cars that they sell, they write extended service warranty policies. That business can be very predictable, very profitable, and it lends itself very well to a captive insurance setup. Exporters and imports. Real estate developers are a good candidate because they generally involve multiple legal entities, and they fall into that 12 subsidiary category for providing risk distribution. Other types of companies. And here we think about workers' comp, general liability, auto, where those present a high level of risk just because of the nature of the business, the nature of the products. These present excellent candidates for a captive insurance arrangement. We often think of dry cleaning as a simple business, but anybody who knows the business knows that there's a lot of environmental risk associated with the chemicals that they use, and that can present an opportunity. The construction-related professions, contractors. In my experience, I had a very interesting situation with a client back in the 90s that was just getting into the asbestos abatement business, and it was nearly impossible to get reasonable workers' comp coverage for these asbestos contractors because nobody knew what the future held in terms of exposure to asbestos. So the folks, the contractors in the industry got together, formed a Bermuda captive, paid their premiums into the Bermuda captive, and at the end of the day, the captive insurance operation turned out to be more profitable even than the removal of the asbestos. They were able to save so much money, through that captive that it truly was a benefit for them. Any contractor, HVAC, electrical, plumbing, these tend to drive pretty high workers' comp rates. The oil and gas industry is another one. Hotels, motels, restaurants. We see it in transportation, in the trucking industry, in the bus, in the car rental business. And if you have a situation where a company provides a form of guarantee or a warranty to its customers along with the goods or services it offers for sale, that can be an excellent candidate for a captive insurance company. I had a situation with a client back in the late 90s that manufactured the rubber roofing material that goes on flat roofs. And along with the sale of the product, they provided a warranty on the installation. It could run from 10 years to 25 years. And they collected a premium for those warranties, and they recorded the premium dollars. And as an operating company that was not an insurance company, they were not allowed to establish any reserves for the future claims. So from a tax perspective, they had to bring all that premium income into taxable income and pay the tax on it currently, and then get a deduction for the losses when they actually occurred. We instituted a captive insurance arrangement that allowed them to move all that business into a wholly owned captive insurance company and obtain an immediate deduction for the reserves that were sitting on their books from a financial perspective. Turned out to be a windfall for them and a much better situation on an ongoing basis. Let's see. Next slide. So some of the other benefits for forming a captive insurance company. Beach Aircraft was a good example. It was on the verge of going out of business because of its inability to obtain product liability coverage. You know, when a plane goes down, it's either pilot error or manufacturing defect. And the insurance companies did not really like the risks that went along with that. So Beech Aircraft formed its own captive insurance company to cover their product liability costs. And they were able to then use their loss experience as opposed to everyone else's loss experience in determining their premium rates. So what happens when an insured forms a captive insurance company like this, they split their coverage between the third party and their wholly owned captive. What they're able to do is gain some negotiating leverage with the third party insurers, still leave some coverages with the third party, but get some negotiating leverage along the way. They basically take that high risk, high unknown, high volume, but low frequency risk out of the equation, and they leave the third party insurer with the low risk, high volume, but high frequency, but low volume, predictable premiums. And it's a nice way to sort of bifurcate your total insurance coverage and give yourself a little bit of negotiating leverage with your third party insurer. The captive would insure those specialty risks, those high volume, low frequency risks that drive unpredictable premiums, but often highly profitable business for the third party insurer. We keep that business and we push off the third party to the third party, the lower, less profitable risk business, if you will. Some of the other benefits of forming a captive, we can use it as a wealth transfer vehicle. How do we do that? We do that if we, again, know that with some certainty that we're going to be able to operate this captive profitably. We can transfer the ownership of the captive to the next generation. We'll touch on this a little bit. This is the micro-captive situation. So Internal Revenue Code Section 831B was put into the Internal Revenue Code way back in 1986, and it was done so in an effort really to help the small farmers mutual insurance companies that had been formed back in the 1800s for the most part, and to provide them with a carve out, if you will, and an exception to some fairly negative legislation that had been enacted in 1986 that affected all insurance companies, all property casualty insurance companies. And so they said, well, you know, we want to sort of punish these big companies, but we don't want to punish these little farmers mutual companies. So they got a carve out. And if their premiums were less than 2.3 million, then they were exempted from all of the negative legislation that had been passed. In fact, they were exempt from paying tax on their underwriting income. So if they took in $2 million of premiums, paid out, let's say 200,000 in losses, and had 1.8 million of underwriting profit, they paid no tax on that 1.8 million of underwriting profit. And that was enacted in 1986. Somewhere along the way, some creative planners found other uses for Section 831B. So essentially the way the micro-captive 831B strategy works is the insured entity, the parent company, lowers its taxable income by the amount of premiums that it pays to its owned insurance company. The premiums that are received by the insurance company are part of the company's underwriting income, which, as we said, under Section 831B is not subjected to tax. So after the non-tax underwriting income and the taxable investment income have accumulated, the captive shares can be sold or liquidated at capital gains rates. So this strategy achieves both tax rate arbitrage and tax deferral. There has been a lot of literature written around the 831B micro-captive strategy. Needless to say, just like the original captive strategies, the IRS is not a big fan of 831B strategies. And we have had recent legislation beyond the scope of this that somewhat limits the ability to use these as wealth transfer vehicles. But they're still viable in many situations and worthy of consideration in planning. The IRS did add these to what they refer to as their dirty dozen of tax scams to watch out for. And in 2016, they issued a notice that requires disclosures by captives themselves, the owners of the captives, and individuals that are advising on the implementation of these strategies. We also had a very unfavorable tax court case that came out in 2017. But this was a situation that was, I'll say, fairly seriously flawed from the beginning. It was a situation where, again, the taxpayer got extremely aggressive in the types of risks they were attempting to cover and the premium volumes that they were pushing into the captive. And so it really came as no surprise that the taxpayer in this case lost the case and also had to pay penalties. So let's talk about some of the steps that are involved in forming a captive. Generally, when we're looking at the possibility or considering the possibility of forming a captive, we'll have a feasibility study that is performed by a captive advisor that has three main objectives. First, to provide a blueprint for how the captive program is going to be operated. Second, to provide assurances that the program is going to comply with all the relevant insurance and tax laws. So we don't leave this up to chance. This is really the intent of the services that a knowledgeable, experienced captive advisor is going to ensure that we have compliance with the rules, with some of those bright line tests that have been established by the revenue rulings and the IRS. And then finally, the intention is to provide the company, the owners, the key decision makers with the tools that they need to assess the viability of the plan. We also have to decide on a jurisdiction. So captives are regulated based on where they are incorporated and regulated. That can be a number of the US states that have captive legislation in their insurance regulations. Some of the more popular states in the US are Vermont, Utah, North Carolina, Hawaii. Recently, I've seen Tennessee is becoming a very popular jurisdiction. Or, they can go offshore, and they often do. In the Bahamas, Bermuda, Cayman Islands are some of the other foreign jurisdictions where captives are established. Things that the captive regulators will look for in accepting a captive application. They will look at the character, the reputation, the financial standing, and the purposes of the actual incorporators. They'll look at character, reputation, financial responsibility, insurance experience, and business qualifications of the officers and directors of the proposed company, and any other aspects that they may deem relevant. So this again is part of what your captive manager is going to help you navigate. They will be knowledgeable in all the jurisdictions that are out there. They will bring that knowledge to bear along with the knowledge of your business to select a domicile that is most favorable for the business that you're trying to write. As an applicant, you'll need to make a formal application to establish the insurance company in whatever jurisdiction you choose. The applications vary from jurisdiction to jurisdiction, but will generally include the following: the amount and description of the assets relative to the risks to be assumed, the adequacy of the expertise, experience, and character of the persons who will manage it. And again, that in most cases is going to be the outside captive manager. That's what, again, part of the services that they're providing and establishing these things. And the overall soundness of the plan of operation. They'll look at loss prevention programs of the member parent or the policyholders, if you will, the member organizations, the insureds, essentially. Other factors that may be considered by the regulators in determining or ascertaining whether the captive insurance company will be able to meet its policy obligations. And then capitalization is a key factor in determining. Each of these jurisdictions approaches capitalization from a different angle, different perspective, different levels, depending on the insurance. So again, part of the selection process is determining what's going to be the most favorable capitalization jurisdiction. So these are some of the individuals, outside professionals, that will be involved in establishing and running your captive on a continuing basis. You're going to have a manager who helps you manage your relationship with that regulatory jurisdiction that you've established, that you've selected. You're of course going to have legal counsel to help you in writing policies and taking care of the legalities of the incorporation and so forth. Pretty much all the jurisdictions are going to require a full CPA audit of the business operations, which of course then will also require actuarial services to determine what the loss reserves need to be. And you'll need to have an investment manager who will, select appropriate investments. Different jurisdictions have different requirements and restrictions on how and where funds can be invested. So you'll need someone familiar with those rules and familiar with investments, obviously, so that they can be deployed efficiently, but also in keeping with the rules of each jurisdiction. These are some of the things that can lead to difficulties if they occur, and may lead to a jurisdiction shutting down the captive, which does unfortunately happen occasionally, but not very often if they're properly managed. But certainly if the company's capital or surplus becomes impaired or insolvency occurs, the jurisdiction will shut it down. Failure to submit the annual report on a timely basis. So in addition, there's an audit report, but then there's also, each jurisdiction has an annual report. The form of that needs to be followed and submitted on a timely basis. Failure to comply with their own governing documents, articles, bylaws. It's not, sometimes closely held companies get a little sloppy with following the form. It's important in these arrangements to strictly follow the form and follow the rules, have the appropriate meetings at the appropriate times, at the appropriate places. All those things are very important to comply with. Failure to submit to an examination by the insurance commissioner. So the insurance regulators in each of these jurisdictions, be they state or offshore, generally have an examination regiment or process that occasionally they will show up at your door and say, we want to examine your books and records. And you also have the privilege of paying for the cost of that examination. And so if you refuse to pay or don't pay for that or submit to it, that can lead to shutting down the captive. And just generally failure to comply with any of the statutes in in each jurisdiction. And again, this is where your captive manager is going to ensure and make certain that you're complying with all these requirements. So what does it cost to set up a captive? Generally, what I've seen in practice, 25 to 50,000 to get through the initial sort of feasibility phase of understanding what policies, what type of risks might we be able to cover, what type of premium might we be able to support, what jurisdictions might we consider to get us through that first step of understanding, does it make sense? How are we going to set it up? What's it going to cost us? And where are we going to set it up? In what jurisdiction? On an ongoing basis, you can assume 15 to 20,000 of out-of-pocket costs. This does not include any costs associated with reinsurance that is required to achieve risk distribution. Does not include accounting fees or tax fees, but 15 to 20 just for your captive manager to keep the thing running. Now, I wanted to do with a little bit of time that we have left is review with everyone a couple of case studies that have come up in our practice here, again, without naming names, but it'll give you a good overview of where these captive insurance may fit into your business and your situation. And they're really good examples of where and how a captive can be an effective tool. The first case study involved a specialty retailer offering product warranties to their customers for an additional cost. So the issue for them was they were able to defer recognizing the taxable income on these warranty premiums because they were received as advanced payments. But the offset on their books, so they basically would write this policy, they would collect the cash, so they would basically debit cash, and then they would credit a liability for advanced payments. And the advanced payments would be amortized over the period of policy and then offset against the costs associated with basically performing on whatever losses actually occurred. And what was happening is the company was presenting their audited financial statements to banks for financing of expansion of operations and so forth. And this liability for advanced payments was growing on their books. And they really didn't understand it. They really didn't like it. And they really didn't want to see it on their books. So they were looking for a way to remove these liabilities from their books and then transfer the risk of these future losses to another related entity for purposes of dealing with the banks. And so what they did is they established a captive insurance company, and the owners of the captive were the principals of the operating company. So it was kind of a brother-sister situation. And they took all this risk and basically took the cash, moved it into the captive, and along with it went the liability for unrecognized advance payments. And they were able to establish loss reserves in that insurance company, so there had no negative tax effect within the captive itself. And so it was a perfect solution for them. It wasn't driven by taxes. This was driven by a desired financial outcome on their financial statements, and it provided a great solution. Case study 2 was a distribution company with a large workforce, vehicle fleet, substantial workers' comp, general liability, and auto insurance premiums. And they were looking for ways to reduce their third-party insurance costs. The solution for them was to join a group captive that pools the risks of companies that are in similar industries. So this would be your homogeneous group captive, a group of unrelated companies, but homogeneous in the sense that they are in a similar industry. But the captive in this situation only accepts companies that have a better than average loss experience. And because of that, the group captive is able to offer the same coverage that a third party would provide, but at a substantially lower premium. Again, because it's only accepting companies that have a superior loss experience track record. Those of you that have been around for a number of years might be familiar with the concept of redlining. Redlining was an issue, still is an issue, where banks and insurance companies draw red lines around a map and decide we are not going to do business in these areas because we see that as too risky. And they tend to be areas that are lower on the socioeconomic scale. And federal government looks at these and says, well, that's discrimination. You can't do that. This is sort of in a form, if you will, of unregulated redlining, where the group captive is cherry picking the best risks that are out there and pulling them together into a captive and saying everybody that has a great financial and track and loss record can participate in this captive insurance company, and those that don't, sorry, you can't participate. So it works, it's effective, and a lot of companies that are in high risk industries in terms of some of those, GL, workers' comp, and auto insurance premiums are able to save substantial dollars by participating in group captives. The third case study I wanted to touch on was a auto dealer. We talked briefly about this earlier in the presentation, who's selling extended service warranty plans on the used cars that they sell. So here, the company wants to participate in the underwriting profits of this line of business. They're fairly significant and they're fairly predictable, and they also want to transfer wealth to the next generation. So their solution was to establish multiple 831B companies with the ownership spread across various members of the third generation. These companies assume a portion of the service warranty premiums along with the related risk, and then they earn the resulting underwriting profits. The underwriting income, not subject to tax because of Section 831B. And so these profits accumulate tax-free until such time as they're distributed as dividends or the insurance company is either dissolved or sold. So we are at the end. This concludes our presentation. Hopefully, you now have a better understanding for how and why the captive insurance industry has evolved over the past 50 plus years as a response to developments in the commercial insurance markets and to tax planning opportunities that were created along the way. I'd be happy at this time to entertain any questions anybody might have.
Great, thanks, Mike. That was a lot of great information and hopefully answered a lot of people's questions along the way. But if you do still have a question, you can put it in the question section and Mike will get it answered for you. You never know, your question could be somebody else's question too that they just didn't ask. So also, just as a follow-up, as you're putting those questions in, we will be sending a copy of the presentation and the recorded version to you this afternoon, so that if you want to go through it again, you can do that. Also, too, there will be a quick webinar survey that will come to you as soon as the webinar ends. Again, if you could give us any feedback, any other topics that you're looking for, and also in there, you can ask any additional questions to Mike, and he'll follow up with you directly to get those answered. Just wanted to let you know our next webinar will be July 18th. It will be on state and local tax. That is always a hot topic in our office and for many of our clients. So we will be talking about that. So keep an eye on your emails for the description of that and get you registered for that one also. But want to thank everybody for joining us today. Thank you, Mike, for your expertise, all this information, some case studies. Those are always great ways for people to learn. And again, if you have any questions for Mike, just reach out. We're happy to help you. And I hope you enjoyed this first day of summer and have a good afternoon, everyone.
Thanks, everyone.
Thank you.